Elon Musk is preparing the largest initial public offering in human history, targeting a $1.75 trillion valuation for SpaceX. To reach that number, SpaceX would have to be worth more than the entire American defense industry combined, more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks put together. Yet the internal data reveals a disconnect. The company is currently operating at a $5 billion annual loss. At this price point, the capital isn't coming from private venture funds or billionaire investors. Instead, technical rule changes have positioned passive index funds as the primary buyers, meaning the money will be drawn directly from the accounts holding your retirement savings. The safety typically associated with index investing is being leveraged to generate demand. New regulatory adjustments are designed to force these automated funds to purchase SpaceX stock, effectively removing the individual investor's choice to opt out. Understanding why this demand must be manufactured requires looking at the actual structure of the business. SpaceX operates as a stack of 3 distinct companies, each with a completely different financial reality. The most recognized division is the rocket business. It handles satellite deployments, cargo for the ISS, and NASA crew missions. However, this division generated roughly $4 billion in revenue last year, a figure that represents only about a quarter of the company's total income. The primary driver of the company's cash flow is Starlink. As a satellite internet provider, it represents the most scalable part of the operation. The margins here are expanding with unusual speed. In 2025, Starlink brought in over $11 billion in revenue, with profit margins jumping from 41% to 63% in just 24 months. While those 2 divisions were generating a combined $8 billion in profit, a third business was added to the stack. SpaceX acquired xAI, an artificial intelligence lab, in an all-stock deal that valued the AI startup at $250 billion. By early 2025, the reality of that acquisition became clear. The division was burning through $1 billion a month, and the entire founding team of researchers and engineers had walked out of the company, leaving an asset that Elon Musk admitted would need to be rebuilt from scratch. This waterfall chart shows the impact of that burn rate. The profits generated by the rockets and Starlink are completely consumed by the AI division, turning a successful satellite business into a consolidated entity with a $5 billion annual loss. In a transparent market, an unprofitable conglomerate would struggle to maintain a $1 trillion valuation. To bridge that gap, the financial system has been adjusted to create a guaranteed source of buyers. The target for this IPO is the NASDAQ 100. Because $600 billion tracks this index, inclusion triggers a massive wave of automated, mandatory buying from every passive fund. Usually, stocks wait 3 months for price discovery. A fast entry rule compresses this to 15 days, forcing premature buying. Additionally, public share requirements were slashed to a tiny 4%, and a multiplier artificially inflates that weight 3-fold. These 3 changes create a domino effect. SpaceX can list with very few shares available, skip the standard vetting period, and force index funds to buy the stock at an artificially high weight. This isn't a strategy for a single company. The NASDAQ has rewritten the baseline requirements to allow a new class of unprofitable technology firms to bypass the traditional hurdles of a public listing. These mechanics ensure that capital is injected automatically. By the time the broader market can evaluate the company's actual value, the index funds have already committed billions of dollars of investor capital. The strategy concludes with the distribution of shares. While most public offerings reserve a small fraction for individual retail buyers, SpaceX is targeting a 30% allocation for the public. Although the company frames this as an opportunity for fans, it functions as a mechanism to offload an unprecedented volume of supply onto individual buyers, who are often motivated by loyalty rather than financial data. This process creates what is known as exit liquidity. As shown in this flow diagram, it allows early insiders to move their shares to a massive pool of retail and retirement accounts that absorb the stock at its highest possible valuation. Passive investing was built on the promise of diversification and ease. However, that automated nature creates a specific vulnerability. The same system that buys the index for you also buys whatever is added to it, regardless of the underlying risk. The features designed to make investing convenient for the middle class have been repurposed. Everyday citizens are now the guaranteed buyers for a massive, unprofitable corporate entity, with the mechanics of the market itself ensuring the trade is completed.